continuing.
Well, Simon, of course, at the Real Estate Talk Show, we get an awful lot of questions. And I think the most asked question, you're probably going to agree with me on this, is where's the market? And not just where now, but where is it going in the future?
Well, not just questions, but we also get a lot of opinions because everybody wants to give their opinion, right? Everybody from your barber, your butcher, your cousin Larry, who never invested in real estate in his entire life, but has an opinion. So that's what I really like about our show is that we get to talk to the people that really do have a better sense of what's going on, expert, factual, educated opinions. And let's hear who our next guest is.
Well, we have the gentleman, and that is Craig Wright. He's the chief economist with RBC. So, of course, you certainly know what is going on. Craig, welcome to the program.
Pleasure.
Now, you have been on here before. Of course, you're a regular feature on our show, but people really do appreciate the fact that you give the candid here. You say this all the time, numbers don't lie.
Hopefully, yeah. That's our goal. It's an opinion,
So
right?
the first question, where is the market?
Yeah.
I mean, the housing market has consistently surprised to the upside. We've recently seen some information from the Bank of Canada, and in their previous statement, they said the housing market looks like it's cooling. And household imbalances, the debt burden, is evolving constructively. And more recently, they said housing surprised to the upside. And they mentioned household imbalances, i.e. the debt load, is a bit of a risk. So it's obviously surprising them to the upside.
But hasn't that been the same story every year for the last 6, 7, 8? I've lost count. How many years?
Yeah, since about 2008, obviously after the global recession, we saw a pretty sharp fall off. The confidence was hit in terms of all of our housing, but since then it's been flatlined, and we've had a few good months and a few bad months. Right now we've had 6 consecutive months of month-over-month increase in resale activity. And what we've seen over those years is there were 4 rounds of mortgage regulatory tightening to try and cool the market. And what you tend to see is they tighten, housing market softens, then recovers as people recalibrate and say, I'm okay with this. And we've seen now 4 rounds, and each time we've seen the recovery, and we're seeing that again. So we're hoping much of it has to do with the weakness we saw early in the year because of the weather, and now we're just getting a bit of a recovery from activity that would have taken place then.
I'm glad you said that because it seems to be a pattern long term. Because, I mean, if you analyze the market on a weekly, monthly, quarterly basis, it's really kind of irrelevant, isn't it? You have to look at the long-term patterns because we saw, Q4 08, we had the economic correction, and the real estate market just took a deep breath and said, well, in the absence of knowing what to do, the Canadian market is being conservative. We'll do nothing.
Yeah.
But we saw a reaction afterwards. 6 months later, there was a correction, bringing it back up to the same trend line. And we saw the same thing this year with a terrible winter. You said it. Very little sales in first quarter, and very few listings, as of course you know. And then we saw the correction again. So isn't that sort of, isn't there an unbridled demand fueled by population? And isn't that really the underlying stimulus?
Well, I think that argues for a high level of activity and doesn't necessarily argue for ever higher. So what we've seen is a few months of recovery. It may be making up for lost ground. It may be a reacceleration because we have seen interest rates move lower. So in the second quarter, we do this housing affordability index, and we've done it since the 80s. So it's what it costs carrying a house. So it's principal, interest, taxes, and utilities relative to income. And what we saw in the second quarter is prices still rose in the second quarter. But notwithstanding that, we had a 37 basis point decline in mortgage rates. So very small decline in mortgage rates, and affordability improved across all the housing classes we look at and across all the regions and cities. So the power of lower interest rates is supporting the housing market. The hope is it doesn't give it that added push higher because, as I suggested earlier with Governor Polis and the Bank of Canada getting more worried about it, you start to wonder if they're more worried about it, maybe more people in Ottawa are more worried about it. And the governor doesn't want to push the currency higher, so we're not going to see the blunt instrument of interest rates to cool the housing market, which means if we continue to see recovery in the housing sector, there may be yet another round of this mortgage regulatory tightening coming to cool it down to more sustainable levels.
So for a lot of people, they're holding off in terms of buying real estate, and for those reasons, because the thought that maybe the interest rates will go up. More importantly, they're thinking prices will go down, so they'll get a better opportunity if they were to wait until next year. Yeah. So what are your thoughts on that?
Well, I mean, what you like to see is people taking on what they can afford, and I think that's what the worry is. People are stretching it a bit too far. So even if they manage to get 5% down, they're arguably doing that and stretched. And if you look at the average loan to value ratio, it's probably that or even higher. So what we're seeing is you'd like people just keep in mind that it is something that you have to manage, and you have to manage from where we are now, which is unsustainable. I would argue unsustainably low interest rates to higher interest rates, and they will be higher when you renew, whether that's a year from now or 5 years from now.
So really, you should be contemplating when you are buying at this current interest rate that you have to foresee in the future and realize, can you continue to carry it when they do increase?
And that's the verbal messaging that we've been getting from the Bank of Canada, Minister of Finance, and others. And I think that's a valid point, is that we are, so many of us, we've seen rates at this low for so long that it's hard to fathom a return to anything close to normal. But at some point, we'll get back to those overnight rates in maybe the 3% range, which is a tripling from where we are, but still very low.
So obviously the message is be conservative, buy the least expensive home you can stomach or your family needs. And if you're nervous about long-term rate increases, lock in. I mean, there are historically low rates for 7-year mortgages now, 10-year mortgages. 10-year mortgages at 3.5%.
But Craig, what are your thoughts in terms of, again, media is portraying that there's an overvaluation in all of the major cities in Canada, meaning the prices are just too high?
Where you see most of the worry about the Canadian real estate market is outside of Canada. So you see the international researchers coming out with these price-to-income ratios, price-to-rent ratios. And I think they don't fully understand the differences across countries, let alone within a country, to Simon's point. So what we see is these price-to-income ratios. Canada had a housing crash back in the late 80s, early 90s. So our prices didn't move for the better part of a decade. So now there's a bit of a catch-up there. But if you're looking at what you thought was normal, in 10 years of no movement in price-to-income or price-to-rent, it looks like quite a spike. But if you look at the broader measures like the sales to listing ratios, the inventory of unsold homes, the affordability like we look at in terms of the affordability index, if you look at some of these others and take into context that we're seeing a mix, so it's not all single detached anymore, it's multifamily, and so people see it's much more visible when you plow over a farmer's field and put a bunch of homes in. It's not quite as visible as seeing these towers that we're seeing all around. So there is a mixed difference that's going on as well. And part of that's affordability. It's cheaper to buy a condo than a detached home. So there's a lot of moving bits. But I think on average, we're still the view that this is going to be a cooling, not a collapsing. And we think it'll come now. We're seeing affordability challenge from prices, and later we'll get an eventual increase in interest rates.
Isn't it amazing, Craig, though, how the demographics, they adapt? In other words, the condos have become now that first-time home buyer, or they've come that, when people come to this country, that's your first home, where it used to be, get that piece of land and get that smaller bungalow just outside of town. But that really has changed. People
also the first investment vehicle as well.
That's true, too, yeah.
Yeah, Toronto's looking a little more like Vancouver. Vancouver's got geography restrictions. In Toronto, we had some regulatory restrictions. So it's the density play. So it's up rather than building out. It is affordability. We look at housing affordability for detached homes versus multifamily or condos, and it's as wide as it's ever been. So if you're looking at getting the housing market, for many, that's the only way to get in. And when we look across, Toronto's population goes about 100,000 a year. Formations with that is about 38,000. We're not far off of that. So it doesn't look like it's this big bubble that many talk about. There are some price increases we're seeing in Toronto and Vancouver, but as Simon suggested earlier, real estate is regional, and it varies across regions, and nobody's worried about Alberta because they're now getting 100,000 people, and that's boosting their housing sector, but that's not terribly dissimilar to what we've seen. It's just not as alarming just yet.
I really want to highlight a point that you just made, Craig, in case somebody missed it. We're talking about 100,000 people a year coming in, which means 38,000 new families, all of whom need a place to live, whether they're buying or they're renting. And when you talk about, the resale market is only 80, 90,000 units a year. When you have close to 40,000 new families every year, that's a dramatic new demand, and the condos are filling the need for new renting. So what's the forecast for the rental market? Because prices in the core are getting high for what some people consider to be high, but on the world scale, of course, very low. But what are your thoughts?
Well, I think when you look at the Canadian housing market, it's really divided into thirds. So a third of people own a house without a mortgage, a third of people own a house with a mortgage, and a third rent. And that's give or take a rough approximation. The rental market, what we've seen is a lot of the activity we're seeing is in fact feeding this rental market. And if you look at the rental vacancy rates in Toronto and across Canada, they're actually still very, very low. So it is being absorbed. So that absorption of these new condos is not a problem.
Yeah, so we're still seeing 1-2% vacancy rates.
Yes, and as you go forward, the starts we see, so as soon as you build a condo, the footings of the condo, that counts as a housing start. But with lags, and it varies by years rather than months, they complete that. So there's still supply coming to the market. So I would think rental pricing should be softer as we move forward, as more and more of the supply comes on of activity that was started, this year or 2 or 3 years ago.
Well, Craig, of course, we don't want to keep waiting until every quarter for you to come back and give us a synopsis of what has happened and what to expect. So I'd like to have you come back, and probably sooner than later if you're willing.
Perfect. My pleasure. Thank you.
Great job.
Yeah, great info as always. Nice to see you.
Thank you. Good to see you.